Hey everyone, welcome back to Corporate Decoder. So, Enovis Corporation just dropped their big annual report, and let me tell you, it is a real page turner if you are into understanding how a medical tech company navigates a world of shifting markets, and, well, a whole lot of numbers. If you appreciate getting straight insights from corporate documents like this, make sure you are subscribed and joined our Discord community linked in the description below. So, what is the big story here? Enovis is a medical technology company all about developing solutions that make patient outcomes better and help doctors and therapists do their jobs more smoothly. They operate in two main areas, prevention and recovery, which is all about things that help prevent injuries or recover from them, and reconstructive, which deals with surgical implants for things like hip and knee replacements. They've been busy too, doing a bunch of acquisitions in both these areas over the year to round out their product lines and expand their reach, especially in Europe. Now let's dive into how they are actually doing. Their total sales for the year ended the 31st of December 2025, jumped up to $2.25 billion. That's a solid 6.7% increase from the year before. A big chunk of that growth is coming from their existing businesses, but they also had a boost from recent acquisitions, although those acquisitions added a smaller amount of sales compared to the previous year's acquisitions. Looking closer at the numbers, the increase in sales in 2025 compared to 2024 was mostly thanks to their existing businesses performing well in both segments, plus a bit of help from currency exchange rates. However, they did see a dip in sales from divesting some product lines like their Dr. Comfort foot care solutions. In their reconstructive segment specially, sales grew by a healthy 10%, driven by strong volumes and a bit of currency tailwind. But what about making money from those sales? Their gross profit margin, which is how much money is left after directly paying for the goods sold, was 59.8% this year. That is a good improvement from 56% last year. This boost came from selling more of their higher margin reconstructive products and also from some supply chain efficiencies. Okay, now for the elephant in the room, or in this case, the massive charge that shows up in their financials. Enovis took a huge hit of over $1 billion for goodwill impairment. This sounds scary, and it is. It basically means that the value they assigned to the goodwill from past acquisitions is now considered much lower. A big reason for this is a significant drop in their stock price. They actually had to write down over $540 million in the third quarter, and then another $500 million at the end of the year. This significantly impacted their net loss from continuing operations, which ended up being over $1.18 billion. So while sales are up, this goodwill hit dramatically impacted their bottom line. And that brings us to the net loss. For the year ended the 31st of December 2025, they reported a net loss of almost $1.2 billion. This is a big jump from a net loss of around $825 million the previous year. So, while sales are growing, those massive goodwill impairment charges really drag down their overall profitability. But here is where companies try to paint a slightly different picture. They often use what is called adjusted EBITDA, which is a non-GAAP measure. This basically strips out a lot of those big, non-recurring charges, like goodwill impairment. On this basis, their adjusted EBITDA actually increased to $403 million. This shows that their core operations are performing better, even though the headline numbers look rough due to those specific accounting adjustments. Let's break down their businesses. The prevention and recovery segment, which includes things like braces and therapy products, brought in just over $1.1 billion in net sales. Their operating loss here was significant, over $374 million. But again, a big chunk of that was that goodwill impairment. However, their adjusted EBITDA for this segment was still positive at around $163 million. The reconstructive segment, where they sell surgical implants, had sales of over $1.1 billion as well. This segment also faced a substantial operating loss of over $750 million, heavily influenced by goodwill impairment. But its adjusted EBITDA was stronger than prevention and recovery, coming in at nearly $240 million. Now, about the money they owe and how they manage it. Enovis has a credit agreement that includes a $1.1 billion revolving credit facility and a $700 million term loan. They were in compliance with their debt covenants at the end of 2025. They also have convertible notes. And it is worth noting that they entered into capped call transactions, which are meant to help reduce potential dilution when those notes are converted. They believe their current sources of money are enough to keep things running for the next year. When it comes to cash, they ended 2025 with about $36 million in cash and equivalents. This is a decrease from the end of 2024. Their cash from operations was positive, around $217 million, which is good, but they also had significant outflows for acquisitions and investments. Remember that massive goodwill impairment charge. This is a critical accounting policy for them. They have to check the value of their goodwill every year, and if it seems like it is worth less than what they paid for it, they have to write it down. The significant drop in their stock price triggered these write-downs, and they are very sensitive to future stock performance, their intangible assets, which are things like acquired technologies and customer relationships, are also a huge part of their balance sheet, valued at over $1.2 billion. And the filing talks a lot about risks. They're really focused on acquisitions as a growth strategy, but that comes with a big risk if they can't find good companies to buy, or if they can't successfully merge them into their business, their growth plans could falter. They also acknowledge their substantial debt and how it can limit their flexibility. The competitive landscape is tough too, with big players like Stryker and Zimmer Biomet in their reconstructive segment. They also highlight the ever-present risk of cybersecurity threats. They have programs in place, but like many companies, their IT systems are vulnerable. They even experienced a cybersecurity incident through a third-party cloud provider in 2025, which impacted some business and personal information. Their 2028 convertible notes could also be a factor. If holders decide to convert them, it could mean a cash settlement that impacts their liquidity, and the market price of their stock could be affected by the possibility of many new shares hitting the market. Now, looking at Enovis's position more broadly, they are clearly in a high growth but also highly competitive medical technology space. Their strategy relies heavily on acquisitions, which has led to significant sales growth, especially in their reconstructive segment with the Lima acquisition. However, the massive goodwill impairment charges reveal a serious disconnect between the accounting value of their acquired assets and their current market valuation. This points to a potential overpayment in past acquisitions or significant market pressures impacting their stock price. While their core operations, as reflected in adjusted EBITDA, seem to be performing reasonably well, the headline net losses are substantial and driven by these large non-cash charges. The risks they outline, particularly around integration of acquisitions and market competition, are very real. Their direction seems to be growth through consolidation, but the execution of integrating these businesses and managing the associated financial impacts, like Goodwill, is paramount. The opportunities lie in successfully leveraging their international presence and innovative product pipeline, but the immediate challenge is navigating the financial fallout from those goodwill write-downs and demonstrating consistent, profitable growth from their core businesses. Alright, that is our breakdown of Enovis's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.